Josh, good to see you.
Happy Tuesday, Richard. How are you, man?
Is that what day of the week it is?
I know. Yeah, preparing for the holiday chaos, both mentally and physically. I'm preparing,
Yes.
man.
Yeah, I think we got COVID.
Did you?
On the far side of it, but it took down the whole family for a few weeks.
Oh
Basically.
no, man.
Yeah.
How are you on the recovery side of things? I mean, you
Good.
feeling better?
Yeah, I feel good now. Kind of through it for the most part, but unpleasant.
Yeah.
It's hard to say what it is these days. There's so many things going around, but I think it's taken a lot of people down, and it got us.
Did you lose your taste at all?
It got corrupted. I didn't lose it, but it was impaired.
There could have been a worse. I mean, there could not have been a worse time to lose your taste, man. Like the holiday season, I feel like this is the time you want to like overindulge.
Yeah,
so
good point.
Maybe there's a pro there. Maybe you're going to sort of self-diet due to the lack of taste. That's what I did in my stint, man. You traveling at all for the holidays? You just going to stay in town?
No, just stay home.
Yeah, understood. I think I told you Thanksgiving, but everybody lives here in Houston for me. So I'll start doing my rounds tomorrow, and then I wrap up on Sunday. So
right.
Wish me luck, man.
Good luck.
We didn't come here for me to work through my therapy with you though, man. I've got I do have, I mean, there's been lots of movement, and I think I'm going to sort of weave in and out of the dollars conversation today. I got a couple finance related questions, but here at the end of the year, I was feeling different. So I'm going to add some color to the conversation as well. I'll start the way that we always start though, just call it my temperature check. Let me share my screen with you and I'll give you some numbers as always. This year, and it's been kind of cool to track the year-to-date numbers. If you look back at all the conversation that we've had, year-to-date, the Dow's down 10.5%, but in November, it was up 5.7%. S&P year-to-date down 20.4%, but November, it posted 5.4% gains. You'll see here in the graph, that's the first time since 2021 that the S&P had back-to-back monthly gains, which I think some would take as exciting news. In parallel, if I'm just giving you the full picture of things, we saw last week the Fed announced their interest rate hike. This puts it at the highest borrowing rate that we've seen since 2007. This is year-to-date interest, but if I give you the big view, you can see 2007 just over it. Highest borrowing rate we've seen since 2007, but the 50 basis point hike that we saw broke a streak. The last 4 hikes that we've seen have been 75 basis points or 3/4 of a basis point. So not as aggressive of a hike. In this, I did read that the rates will stay high with no reduction through the end of 2024. The new terminal rate, the ceiling rate, is 5.1%. So all this data, we saw some gains in November. We saw rates continue to be hiked, but maybe slowing. I'm just curious here at the end of the year, man, how are you feeling?
As skeptical as ever. So I think I've used the metaphor before of like driving a boat. You know, you turn the steering wheel and nothing happens. And then, so you turn it some more, and then all of a sudden the boat like swerves, you know, out of the lane because there's a delayed feedback in when you're steering a boat. And it's it's the same with the economy. The economy is a huge boat, right? I mean, when you turn, you know, the steering wheel on the economy, it takes forever. You know, there's a famous saying, I forget exactly how it goes, you know, monetary policy lags are long. And so anyway, I think the Fed has overshot the mark, and they're going to have some shocks that are going to kind of get them to start moving in the other direction a little bit. And then they're going to oversteer in that direction, and then they're going to oversteer back in that direction. And we're going to all have to live through that. So there's not going to be a soft landing. There's more pain to come. no doubt about it. And everybody should brace for continued volatility and ultimately for lower financial asset prices, you know, in the next 6 to 18 months. So I have one chart that I think is worth looking at. Let me see if I can find it here. This is back from the 1970s. Okay. Last time we had, you know, really big inflation, and it points out inflation comes in waves, you know, this is, and you are here, right? I love this. Okay. This is the first wave of inflation, 71 to, you know, then going down, you know, into 72, right? And then boom, up into 75 and down into 77. And then still didn't really get it under control, overshot, you know, undershot, and then boom.
Wow. Yeah, this shows that over pivot. Wow.
This is just, you know, this is how it works. You oversteer, you overshoot, you know, then you've got to scramble back to try to undo what you did, but then you don't, you know, you didn't do it enough. So now you get another wave. This is how cycles work. And I really think we're in for something like this. I don't know if it's going to be 3 waves like we saw back in the 70s into the early 80s, but I really think that we're ultimately, you know, the inflation genie is out of the bottle. You do not just stuff it back in with a bunch of aggressive, you know, hikes of short-term interest rates. They haven't started selling off their balance sheet yet, even, you know, they haven't started quantitative tightening. So there is a lot more to unravel. And meanwhile, the narrative out there is this: the Fed is going to achieve a soft landing, which is just humorous.
Comical,
so,
yeah.
So I think everybody needs to be careful.
That's a powerful chart, and really good insight.
You know, it really is.
There's no secret. I'm going to give you my next question. There's no secret. I mean, charts like that. I'm a research guy. I'm a data guy, and you're all about removing emotion. That's what this conversation and this podcast, I'll put in quotation, this podcast has been about, is realizing your emotion, realizing your humanness, and then helping you understand the decision factors and how to start to remove that. I'm teeing up this thing of, I'm a data guy, and if anyone's listened to my podcast or listen to me in a sales pitch in my 9 to 5, I geek out on research. And so yesterday I saw your Finiac newsletter. You released the correlation calculator, which was really cool. I'll play with that over the next couple of days and probably have a question about it. But prior to that, and I'm going to share my screen just really quickly. Prior to that, you launched this new asset details page. And first, I'll give my shout out to Dan Muse here. This is an awesome article, but I almost lost my mind with this, man. Giving you a sort of single pane of glass with lots of data instead of me having to jump around with several sources. I don't want to steal your thunder here. My question here is maybe twofold. One, could you just show us this asset details page? Then the second question is, as you and the team pulled this together, built this and launched it, what are the use cases? How do you see this asset details page being used? Why is it important is the question.
All right. Back to my screen. Before I get into that, let me just show you this chart that we found this week that I thought was really an eye opener. So where'd this thing go?
It's maybe the most back and forth sharing we've ever done, by the way. Okay, not planned.
All right. So this is pretty incredible. Okay, so this says these are 3 different portfolios, okay? 10 years of performance. And they each have the same annualized return of 10%, okay? So they all have a 10% annualized return. But they all have a different compound return over the 10 years. Okay, so they each made 10% a year, but the compound return at the end of 10 years was 9.8% for this blue line, 9.6% for this green line, and 8.3% for this yellow line. What's the difference between these three? How do you get the same annual return, but a different compound return? It's the volatility, okay? So if you have a comparable annual gain with less volatility, you get a higher compound return. And you get this green line, is 10% volatility. So double the volatility of this one. And this one is 20% volatility. All right. So, lowering portfolio volatility is integral to achieving better compound returns. Less volatility equals more wealth, all else being equal. Okay. Really important. And then my contention about the markets is that most of retail finance is about seducing us to take on more volatility than we need to take on. And then, the Citadel Securities and the market makers of the world essentially skim off of that excess volatility, which is reducing our returns and taking our returns and putting them into their pockets.
Yep.
Okay. So the people that know this, the market has excess volatility way beyond what, statistically the market should have. That excess volatility is essentially manufactured volatility that lowers our overall returns and that allows, sophisticated market participants to basically take the difference between this line and this line, right out of our pockets. So,
yeah, this super powerful,
right?
Yeah, absolutely. This is super powerful.
If you're a professional investor, you're investing in things that are already kind of optimized for the trade-off between gains and volatility. Okay. But for us dopes, we're not, we are getting, drawn into unnecessary volatility all the time. So that is really what Finiac is about, which is how to help people, get from this line to this line.
Look at this graph.
It's not about getting higher annual gains. It's about getting
reducing your volatility.
Higher annual gains with lower volatility.
Wow.
Okay. To increase your overall compound return and not give this money here to Citadel Securities or Robinhood or, whoever it is that's, all the people out there trying to sell you. Oh, but, we haven't talked about FTX. I do want to talk about FTX for a minute. And here is, and one of the things I want people to understand is that it was never about FTX. It was always about Alameda. Okay. And this is Alameda's pitch deck from 2018, the first time Sam Bankman-Fried went out to raise capital for Alameda. Okay. And here's what he promised: high returns with no risk.
Beautiful.
Beautiful. These loans have no downside, right? So, high returns with no risk. This is the first thing he said when he tried to raise money, right? And everything he's done since then has been about convincing people that this was high returns with no risk, which is, impossible. Okay. It's a law of the universe, whatever you want to think about it. It's trying to convince you that, you can do this when really he's bringing you down here and he's pocketing the difference. Okay. And that's what financial fraud is. It's getting you to take on more volatility than you need so that somebody else can arbitrage away that gap. So high returns with no risk, that was number one. And the other thing that he did was he structured it as a loan, right? You're not becoming a limited partner in his hedge fund. He's structuring this as a loan, 15% annualized fixed rate loans. What does that mean? That means you don't get to see any of the books. Okay. You're not a partner in his venture. You're just loaning him money. And you're going to get high returns with no risk, and you're not going to see anything behind the curtain. Okay. So that's Sam Bankman-Fried in a nutshell. He told us this is who he was back in 2018 when he was pitching Alameda.
Sure
FTX was just a way for Alameda to have better trading privileges and then eventually to get customers money to fund, the gaps at Alameda and allow the hedge funds to continue the Madoff-like facade of higher returns with no risk. And this is how financial fraud works, right? You promise high returns with no risk and you don't let anybody see behind the curtain.
Mm.
And that's the story of Sam Bankman-Fried. It's not just him, right? It goes on at different levels all throughout the financial industry. But that's what's going on. And, that gets us into this unnecessary level of volatility, and it lowers our overall compound returns.
Mm.
So that's it in a nutshell. So why do we need, Finiac, right? So, and let's look at these pages now through that lens. And by the way, these are free. This is in front of the paywall.
Mm.
Every ticker, in equities and crypto, are here for the browsing. What did we looked at? We looked at Taiwan Semiconductor last time we talked, right? So basically, you can see that it's got, the growth has not been good, but hasn't been for a lot of things, right?
Sure.
The D score is essentially the volatility, right? So if we look at, for example, SPY, the S&P 500, D score is 2.79%. That's telling you, once a month, you should expect, a bad day of, 2.5 to 3%, or a good day. That's just volatility, actually, up or down, right? But then if you go look at TSM, 4%, right? So it's more volatile than the S&P 500. And you can see, the growth is going down. The trend is down right now. Okay. Don't necessarily want to try to catch a falling knife. But again, you're looking to build a portfolio where you're trading gains and volatility, and you're not taking on unnecessary volatility. So, if you want the average gains of the S&P 500, what has it been 7-8% a year, you have to put up with probably 2.5 to 3% D score. Okay. If your portfolio is higher than that, you're taking on unnecessary volatility. If you had everything in Taiwan Semiconductor, 4% D score, then, you're taking on unnecessary volatility. You're lowering your compound annual returns. So if we go ahead and log in to Finiac, here's a portfolio. I think we started to look at this last week too. The D score on this portfolio is 2.64%, about in line with the S&P 500. If I went to TSM here, I can see similar, information that you can see on the free pages, but now you can see it relative to your portfolio as a whole. Risk efficiency, not doing too good right now. A lot of volatility, growth going down. You can compare it to the S&P 500. Obviously, TSM is more volatile than the S&P 500. The growth has been less than the S&P 500. So this is a way that you can build portfolios. So you are not taking unnecessary volatility, and you're not giving away your compound return to, those market participants that want to see you take on extra volatility because it's good for them, not for you. Okay. So this is the piece that nobody really has access to right now. And this is why we focus on volatility so much in terms of building a smart portfolio. And so, all these pages at Finiac. Our, any ticker, basically. You can play around with it. It's free. Of course, you can sign up for free right now still. We also built a correlation calculator where you can start to see how assets are correlated. And yeah, so it's still a work in progress, but it's coming along, and we're very proud to be able to bring this level of sophistication to individual self-directed investors and traders.
Feels empowering.
I think it's really needed. I think it's really
100%.
needed, but it does take education. It's like, how do we present this to people in a way that, they can get it right, sooner rather than later, right? That's why this is so much a design issue, really. These tools are used by professionals, institutions, banks every day, right? How do we get them into the hands of the public in a way that, they can be understood and leveraged a lot faster? That's really what we're working on.
Two thoughts. The one is, how do we get them to get it? I think the walkthrough that you just did is damn near the best I've seen. Like that was powerful, man. To see the same annualized returns on 3 portfolios, and the only difference, all else equal, the only difference being the volatility in those portfolios, and then seeing 10 years later what that does to your overall portfolio, to your gains and returns. That's impactful. That's the problem that you have set out to solve, and closing that gap. And then just a sidebar, the pitch deck that you showed, it's kind of it's almost comical. It's kind of haunting to see that deck and now draw the lines backwards and know what we know now. And then you see that first slide and you're like, how were red flags not just firing off? And how is he not laughed out of a room? That's it's scary.
It's really disturbing how this got as far as it did. And, to me, it's like, you got to look in the mirror, like, how did we essentially enable this? And how do we participate in this, financial game where we really don't ask any hard questions, and we're just playing a greater fool game. Can I get in and out before, the rest of the fools? So it's you say when you point a finger at someone, there's always 3 fingers pointing back at you. And I think as an industry, the financial industry really needs to take a look at that in a big way, and Sam Bankman-Fried is just the latest fraudster. This goes on in equities. It was a little more intense with unregulated offshore exchanges, and all of the aspirations of the crypto community. But man, I mean, you can't understand what's going on behind the curtain. You really have no idea what you're investing in.
It's crazy.
Yeah. It's crazy.
I was on Discord. I had a question submitted, and I'll give the simple answer is your 7 principles course would definitely field this in a bit more of a thorough way. But I want to tee up the question and see if you had anything that you could just immediately share with us. And the question was around knowing how and when to sell your winners. And I like the you don't want to catch a falling knife. I think this is going in the opposite direction. Like, you don't want to, I don't know what the metaphor is, but you don't want to sell off all of your winners. Let me tee up the question. I'll maybe even paint like a little story or a picture for us, just so the question makes more sense. But let's say, Richard's sitting at his house a couple months ago, beginning of this year. You think COVID's coming back, and you're like, dude, I'm I'm doubling down on Netflix. People are going to stay locked down. I'm going to invest. You plug it into your app. The app agrees. Sure, Netflix would be a great addition to your portfolio. I'll show you what Netflix has done. But let's say this happened a year ago. So we're looking at May-ish. You go to invest in Netflix. And since then, that bad boy has just been crushing, right? And over the last 6 months, you've seen a almost 70% return. And this is totally made up. I'm just getting to my question of, let's say you're on this ride and this thing has been skyrocketing over the last few months. The question submitted, and I'm hoping you can unpack for us a little bit, is what is the strategy and how to get out of this? Do you there's this gambling metaphor of you show up with $100, you bet, you win some money back, you take your $100 out, and now you're playing with house money. So do you do that here? You invested some money, you take your principal out, now you let the house do its thing. Do you maybe keep it all in and let it ride until it turns into that knife, and then you try to catch it before it starts falling? What's your process? And I found a winner. I don't want to ride this thing back into the dirt. How do you think about this?
Well, the hardest answer really is that, goes back to what Jack Schwager shared with me about, that was a quote from Bruce Kovner, I think, that 90% of risk management is knowing when you'll sell before you buy. So, it's really tough. It's really tough. It's not easy. How long do you want, why did you get into Netflix in the first place? What was your thesis? How long did you want to hold it? Is this like a buy and hold, for 10 years in your portfolio? Because you think, you have a thesis about Netflix that it's really going to rule media and entertainment for the next generation. What's your thesis, right? Or if you don't have one, can you follow somebody who owns Netflix who does have a thesis about it, right? Maybe you can do that at Whale Wisdom, for example. See what funds are in Netflix and which of the advisors that you like, who are the asset allocators, right? Who are allocating money into Netflix. What do they say about it? So what is your thesis? How long do you plan to hold it? What's it going to do for your portfolio? These are all questions that you have to ask before you pull the trigger and buy, right? So if you just pulled the trigger and bought back when everybody was puking up Netflix, which is not a bad, thesis, and you're like, well, I'm just going to be a contrarian here and catch a bounce, then you probably need some kind of mechanical exit strategy, like a trailing stop, or if you get to 100% gains, then you sell half of it and you ride the rest with the house's money. One way or another, though, you have to know when you're going to sell before you buy. So if you're in it right now and you got lucky and it's up 70% and you have no idea, probably ought to just sell.
Yeah, pull the cord. Yeah.
I like to look also, what's going on in a macro perspective, right? I shared my thesis about my macro view. I had the similar view at the end of last year. I never said I was getting out of the markets altogether, but I definitely said, I think this is a time to lighten up rather than double down.
Yeah.
I do think that the market is exploring a bottom at the moment. I don't think it's going to hold personally over the next, 6-12 months. So that's my macro thesis. I'm biased towards energy and even gold right now. In terms of my equity investments, I'm biased towards real things and not financial and technology things. And so, if I were holding Netflix and I caught that wave, I'd be selling and counting my lucky stars personally. But 90% of risk management is knowing when you'll sell before you buy.
Awesome frame up. That can be double clicked on in the 7 principles piece, but what you just labeled there it's spot on, man. If it was the story I just told and you just got a random idea and you're like, let's ride with it, now's the time to hit that hit the button.
Yeah, hit the button.
But if you had something bigger and you were married to a purpose, or you found someone, we talked about Kathy Wood a few times, someone like that, where they've given their opinion and you're like, that makes a lot of sense. We're going to ride this thing out with her for 2 years or whatever that is. There's a story there that you can attach yourself to. There's a deeper purpose.
And
it
if
wasn't
you're going
just
to do that, then you
idea.
look at what the volatility is and you say, how much, could I potentially lose here? How much do I have to put up with a 50% correction potentially in order to stay in here? And if that's the case, that I could lose 50% of my money, how much money can I put into this? And all of that is done for you in the Finiac app.
Yes, sir.
Right? Position sizing based on volatility. So I think these are all really important things that most people don't, no clue about.
I had 2 more questions. I'm looking at my time. I'll make sure I don't run over for us. You'd mentioned energy and gold. The last couple of weeks, last couple of months, I personally, because I'm in the tech space, have been taking shots at the tech space. And then the last time we met, I showed you the amount of layoffs that are going through that field. I feel like I have a small victory that we could maybe celebrate about the tech space. And I wanted to see if you had any thoughts on it. I don't know if you're familiar with OpenAI, but they've built a couple tools, couple technologies. Most recently and definitely most relevant is GPT-3. And this tool, I'll show you a few of the use cases, is literally limitless, is what it feels like. I mean, it is pulling from all sorts of databases and sources and giving you, it is a Google search box into a machine where it is spitting out answers. And here's some of the use cases you've seen: people doing SEO, writing stories, writing graphics. How do you explain mechanics or quantum mechanics to my 7-year-old? It's like crazy stuff that you're able to input into this submission form and get back an answer. And this GPT-3 has just skyrocketed in popularity. To say that it caught fire, went viral, is an understatement. It is the fastest tool to ever hit 1 million users, the fastest app to ever hit 1 million users. Instagram took 75 days, Spotify 150. These guys got there in less than 5 days.
That's crazy.
I mean, AI is definitely emerging at an insane rate. And I think what's interesting is it seems to be pretty polarizing, and you're either on board with this and you like where it's headed, or you're really afraid and scared and maybe even a little doubtful of this is NFT like this thing is going to surge and then crash. Are you a fan? Have you heard of this? Any predictions, thoughts? This seems really cool. I want to give the tech space a little shout out for a second.
I have certainly heard of it. It is doing some amazing work. Beyond what I expected, frankly, but I do think it's also has some serious perils. I was just looking at something earlier today, actually. I probably still have it up on my screen here. It was a Twitter post. Where is this? Yeah, here it is. All right, so this is talking about language models that have a lot of parameters, like Chat GPT, okay, really huge models. And what it's saying is that as the models get bigger and bigger, the tendency to feed back to you the answers that you want to hear go up astronomically. Okay, so the percent of answers matching the user's existing views as your models get bigger and bigger, go up from like 50-50 out to like 80%, right? So we know that AI has built-in biases. And so to just get like, googly-eyed and lightheaded over some of the amazing things that you see, produced by Chat GPT is a big mistake. This is just a hammer, man. It's just another hammer. And we can't forget that technology is a tool that's used by people. It does not replace people.
Yeah.
And that is, you know, a big danger. So yes, it's impressive. Some of the things are absolutely unbelievable that are generated out of Chat GPT. And we've even been using it some ourselves. So, you know, it's a great place to start. And I think it's, I think Google is probably quaking in their boots, you know, because think of how much more impactful the search is that you can get out of Chat GPT than what you have to put up with if you go to Google. So it is a landmark. It's a milestone. I just caution us from getting carried away about, you know, it can easily become another hysteria, and those never end well.
There's definitely pros and cons to it. We could probably spend the hour talking about some of the bad things. There's been because it's scraping the web. What's 175 billion data points or something? Yeah. You know, there's been lots of examples of it, like hypersexualizing women because of the number of
absolutely.
There's just all sorts of crazy things out there that they're gonna have to clean up. But
it's not intelligence.
Yeah, exactly.
We are still ultimately responsible for our own decisions and our own influences. And that's the danger of AI, that you just start to think, oh, this is more intelligent than me, and I can just abdicate. You know. So.
One more question, and I'm going to get to my question in a roundabout way. We've hinted at talked about Elon and this Twitter saga a handful of times, and this may be the last time we bring it up. And my question's not about Elon per se. Maybe just my little recap here. As Elon took over, and I think we talked about it in the podcast here. One of his first moves, as he was going from what he called Twitter to Twitter 2.0, was he sent out this ultimatum to his employees. Basically, is like, get on board for long hours, high intensity, or you can leave. And through the ultimatum plus the layoffs that Twitter went through, they went from something like 7,500-ish employees to less than 2,500 employees. I think I saw 2,300 now. That approach of, here's an Excel doc, your name's in it, mark yes or no if you're on board with this. That's very direct. It's very dry. But as a sales guy and as an ex-athlete, the directness and the competition that type of approach brings to the table, that excites me. And I know that you work long, hard hours. I've gotten emails from you at weird times. My question isn't about Elon, but it's about the approach to get the best out of others. And I mean, you've got a team that you're working with. You've built a really awesome app and had an exit. You're in this one now. You've launched things. You're building things. What's your approach in getting the best out of others? Do you have any strategies? Can you relate to Elon, and are you direct like this, or do you try something softer, if that question even makes sense?
Well, I think Twitter was way too soft pre-Elon. So it's incredible to see the same business operating at a third of the staff. What the heck were 5,000 people doing, you know, that they're not doing now? And I don't know if you've been following the Twitter files, but the most interesting thing to me is that culture that was present in Twitter, that was just like, come into the office and figure out who you're going to, like shake your finger at today. It's like bad boy, bad girl, and like that's your whole job of like policing thought, essentially. And it sounds miserable.
Yeah.
So, look, I don't know Elon. He's, I think he's a double-edged sword. I'm comfortable with a lot of things that he does, but cutting Twitter from 7,500 to 2,500, can't fault him for that. you know. And getting back to your question about how do you inspire people, you have to have a purpose, you know. You have to be doing something that people are like, wow, I want to be a part of that. So is it just, you know, hey, we're just going to be extremely hardcore? That doesn't really seem like a message that is saying, you know, that's enough of a purpose. Like our purpose is just to be extremely hardcore, you know. No, that's not a purpose. But if you really believe in freedom of speech and that Elon is really going to do something to change the conversation around freedom of speech and really and create more freedom of speech, then yeah, extremely hardcore is great, you know, to be involved in something that is going to have a positive impact on the world, and ultimately that you can derive a financial benefit from too. You can go extremely hardcore for that, but just extremely hardcore by itself, no thanks.
For what it's worth, and I'm done with questions, man, but I have felt that from you all year. The inspired piece, the dedication to what you're after. I leave these, I've got to like change shirts from, I'm just soaking in sweat with excitement, man. Like you bring it for me. And this has been a pleasure all year, man. As we wrap up, I mean, any words of encouragement, end of year trends, just holiday advice for the listeners?
Let's see. I mean, I think I've been saying for a while, go analog in some aspect of your life. You know, this digital world it has its place, and it has its benefits, and there's a lot of great things that come from it, like having this conversation, for example, right? But it's not to be mistaken for the things that, you know, we've done as human beings for thousands of years. So holidays are a great time to remember that, be with family, unplug, you know, don't bring your phone to the to the dinner table, and let's have a balance between analog and digital.
Have a great time with friends and family, man. Thank you for your time today.
Happy holidays, Josh. Happy New Year. Thanks for all your great questions this year, and look forward to talking again next year.
Yes, sir. See you next year.
Bye.